Hey there, financial freedom fighters. Have you ever wondered how the wealthy seem to get richer even when they're swimming in debt? If you're thinking about clicking away, just remember, this is the kind of information that separates the millionaires from the rest. So, stay tuned. Before we unlock this secret vault of the rich, let's make sure you're part of our community. Go ahead and like, share, subscribe, and hit the notification bell so you never miss a chance to boost your financial IQ. Let's dive into the deep end of the wealth pool, shall we? First up, we have what I like to call the leverage ladder. You see, rich folks are a bit like tightrope walkers, and their balancing pole is leverage, also known as debt. By borrowing money, they can purchase assets that appreciate over time. Think about real estate. The rich often use leverage to purchase properties. By borrowing most of the purchase price, they control a large asset with a relatively small amount of their own money. Over time, as the property appreciates, their equity in the property grows. The debt essentially becomes a tool to increase their returns. Moving on to the interest illusion. Imagine you're in a race, but instead of running, you're paying off debt. Now, if the rate at which your assets grow outpaces the interest on your debt, you're winning. That's what we call the interest illusion. Here's an example. Let's say you take a loan with a 4% interest rate to invest in a business venture that yields 8% annually. That 4% difference is your gain. The wealthy often borrow cheaply and invest in higher return ventures. They make their money work twice as hard, essentially turning the tables on interest. Have you checked the description box below? We have some top-tier resources that can help elevate your financial game. Don't miss out. Let's talk about the taxman tango. Yes, even the taxman can become an ally. You see, in many countries, interest expenses are tax deductible. It's like having a discount on your debt. For example, if a business borrows money to invest in new equipment, the interest on that loan is often a tax-deductible expense. This effectively reduces the real cost of borrowing. It's a financial two-step that can lead to significant savings, and it's a dance the rich know well. Now there's a question to ponder. If you could get a loan to invest in an asset that you know will appreciate, would you take the risk? Share your thoughts in the comments below. Next up, we have the inflation infiltrator. Remember when a candy bar used to cost a nickel? Inflation can eat away at the value of money over time. But when you're in debt, it's like the money you owe is getting smaller, while your assets keep growing. Inflation is like a secret agent that slowly reduces the real value of money. Let's say you take a 30-year mortgage. The money you'll pay back in 30 years won't have the same purchasing power as it does today. Inflation effectively eats away at the debt, making it cheaper to pay back in the future. The rich use this to their advantage when planning long-term debt strategies. Let's move on to the cash flow creator. Wealthy individuals use debt to generate a positive cash flow. They borrow at low rates to invest in assets that yield higher returns. Imagine borrowing $1 and making $2. Now that's a magic trick. For instance, if you borrow at a 3% interest rate to invest in a rental property that gives you a 6% return, you're netting a 3% gain. This model of using borrowed money to generate a steady stream of income is a favorite among seasoned investors. It's a bit like using a borrowed fishing rod to catch a fish every day. Let's now turn our attention to the risk redistributor. When the wealthy take on debt, they don't carry all the risk. If an investment goes south, it's their creditors who share the burden. Here's a scenario. You borrow money to invest in a business. If that business fails, you might lose your initial investment, but the risk is shared with your creditors. The rich use debt as a form of risk management, effectively spreading the risk among all stakeholders. It's a bit like distributing the weight of a heavy object among several people. Last but definitely not least, we have the credit score champion. Believe it or not, debt can boost your credit score. Timely repayments show lenders that you are trustworthy, and that can open doors to even better opportunities. Maintaining and repaying debt responsibly helps build a strong credit history. This could mean better loan terms and lower interest rates in the future. It's like acing a test that enables you to qualify for the honors class. The rich understand this and use their debt strategically to improve their creditworthiness. And that's it, folks, your blueprint to understanding how the rich use debt to amass wealth. Remember, climbing the wealth ladder is not just about having money, but understanding how to make it work for you. These strategies don't just apply to the mega-rich. Anyone can implement them with the right knowledge and discipline. But remember, it's important to thoroughly research and consider the potential risks before diving into any investment or debt strategy. As we wrap this up, just remember, knowledge is power, but action makes the difference. So, what's your next financial move going to be? Until next time, keep fighting for your financial freedom.